The two main charitable trusts are charitable remainder trusts and charitable lead trusts. These trusts are both considered split interest trusts because they have both a non-charitable and a charitable beneficiary. Charitable remainder trusts provide for an immediate income interest payable to a non-charitable beneficiary, either for a term of years or the duration of a lifetime or lifetimes, and then the remainder passes to a charitable beneficiary. A charitable lead trust is actually the mirror image or the opposite, where a charitable beneficiary has the immediate income interest either for a term of years or for a lifetime, and then non-charitable beneficiaries receive the remainder at the end of the term.
The best way is a considered way that takes into account the objectives of the donor. Does the donor or somebody in the donor's family need an annuity or a payout for a while, but can afford to give to charity at the end of their life? That's a great candidate for a remainder trust. Then on the flip side, with the lead trust, where the charity's getting the money to start out with and then it goes back to family members, that could be a nice way to postpone distribution to family members, let them mature a little bit. Meanwhile, charity's getting their money. In today's low interest rate environment, those things happen to also work very well. And they can fulfill practical objectives, both to get money to charity now, get money to family later, and hopefully take advantage of the fact that the interest rates are low relative to how the trust might perform.
The charitable lead trust is a little bit different than charitable remainder trust in the sense that the charity is actually getting current cash flow from that trust in the form of payments. And the deductibility of that is fairly similar, that the individual and the family is getting a charitable tax deduction in the year that the trust is set up. But it's a stream of payments essentially that every year are going to fulfill the charitable giving of that particular family, and those assets sit in trust, and at the end of the term of that trust, which is usually at the death of the donor, the remaining assets can go to the family or the beneficiaries of that trust, which is typically a spouse or children. To contrast that with a charitable remainder trust, the charity actually doesn't get the funding up front. There's actually the opposite. The beneficiaries are receiving an annual income stream from the trust that the donor has set up for them with the monies that have been contributed. And at the end of the time frame of that particular trust, the remaining assets will go directly to the charity. In both cases, the income tax efficiencies are fairly significant in terms of the income tax impact it could have, because the full value by doing various calculations can actually be realized as a charitable deduction upon setting up the trust.